Hey folks, welcome back to the channel. As you probably know, over the last 1 month period, we've had most major indexes down. However, with a diversified, actively managed portfolio, it is possible to still make a gain even if the indexes are down. But knowing which high-quality companies to buy requires high-quality research. So in today's video, I'm going to share some free online tools that help me make more informed investment decisions and gives me a better idea of which stocks to buy and when is a good time to buy them. So if that sounds interesting to you, kindly boop the like button for me and we'll get started with the first one, which is finviz.com. And there's a lot of useful ideas you can grasp from this website. First of all, they have a screener, which is really nice. So, for example, if you only wanted to search for stocks that had a PE ratio of under 20, let's say, and you want the gross margin to be at least, let's say, 30%, and you want the stock to have a history of growing its profits year after year. So we can say the EPS growth past 5 years, let's say that's going to be over 15%. And you can see in real time, it basically filters all of the stocks that meet those criteria. So I'm not going to go like super deeply into the screener because it's pretty much like any other stock screener that you might find on the internet. And as you can see here, it lists not only US companies, but also stocks in other countries as well. If you trade Forex, they have a tab for that. And if you want to see what's going on in the futures market, there is that. And one of the most popular functions of Finviz is in the maps. So if you click on that, you can see the one-day performance of pretty much all the major companies, in this case in the S&P 500, but you can change this to any stock market you want. So I can look at Canada, for example, or Brazil down here. But going back to the S&P 500, what's really nice is instead of just looking at a one-day performance, you can change this to a 3 month, 6 month, or even 1 year performance. So how you can use this is this will give you a good idea just by looking at all of the red boxes, all of the stocks that are down a lot over the last year. So for example, you can look at Amazon and think, okay, so it's down 26%, and maybe you know a little bit about the fundamentals of the company. So this might be a good time for you to do a little bit more research on this since it's down, and you might consider if you want to buy it or not. Right. On the other hand, with the energy companies like ExxonMobil or Chevron, you might think, well, they're already up 73%, and it looks like oil prices have peaked earlier this year. So maybe now's not a good time to be buying these. So if you like banks and the financial sector in general, you can look at this and you can look at some of the companies with the most significant drawdowns like JP Morgan here, and you can do some research into that company and find out why it's down so much. Is it because their revenues are falling? Are people not banking with them as much? Are their profit margins getting squeezed? And if it's just short-term problems, then maybe this is a great buy at this price because it's already down 29% over the last year. And now may be a good entry point as a long-term investor. So that's one way you can use this. But you can also screen for other metrics. They even have like PE ratio in here as well. So you can get a broad overview of the PE ratios of some of the largest companies, and you can compare them right away. So for example, oh, Apple's at 25, Microsoft's at 26, so they're not much different. Oh, but Adobe's at 35, right? So why is that the case? Is Adobe growing faster or expected to grow faster than these two? So you can check out the individual stocks' expected future growth and then decide if that higher PE for Adobe is warranted or not. And if you want to take into consideration growth along with PE, then they actually have a PEG ratio here as well that you can look at. And PEG is basically the price to earnings to growth ratio. So for example, if the PE ratio for a stock was 15, but it's also expected to grow its earnings at 15% a year, well, then you have a PEG of 1. And this would be considered pretty cheap. Now, if the PE was much higher, let's say 30, and the company was still expected to grow at 15, then you would have a PEG ratio of 2. And this would be less attractive because it means the growth is not really keeping up with the high multiple of the PE up here. So again, this gives a really nice overview of the PEG. For example, just looking at oil again, we can see that ExxonMobil has a more attractive PEG ratio than Chevron. So you can dig a little bit deeper into that and find out why. But all else being the same, XOM would be a better investment today than CVX. And let's take another one like Pepsi and Coke. A lot of people like to compare these two companies. So you can see Pepsi has a PEG ratio of 3.15 and Coke has 5.05. So Pepsi would therefore be a cheaper stock to buy given the PE ratio and how they're both expected to grow in the future. Now, at 3 and 5, I would say both of these are pretty expensive. So I would not be a buyer of either of these companies. Walmart's at 4.42 and Costco is also pretty high up there at 3. Generally, I would like to see a PEG ratio between 1 and 2, and obviously the lower the better. So if it's lower than 1, like Target, then that would be a really good buy because that would mean the expected growth of the company is higher than what the PE ratio is. For growth companies without earnings, you can use the price to sales ratio. You can see there's price to book, EPS growth in the past 5 years. So dividend yield, if you're a dividend investor and you want to plan out for your retirement and how much money you need to make, this is an excellent screener to plan for your cash flow needs, right? So going back to consumer defensive, so Coke is paying a slightly higher dividend right now than Pepsi. So maybe if you want to balance out your portfolio a little bit, you can allocate less capital to Pepsi and a little bit more capital to Coke just to take advantage of that slightly higher dividend yield if you're planning to like live off the dividends for your retirement, for example. So really cool website. I haven't gone over some of these other tabs, but feel free to take a look at them. And as you can see, you don't even need to register your email or anything to use this. It's all free. And of course, it's all color coded. So back to looking at price to earnings ratio, PE here, we can see that Google is kind of faded red, meaning it's a little bit higher, and then Meta is kind of faded green, so it's a little bit lower. So all else being equal, Meta would be a better buy today than Google. It is a cheaper stock to buy, and you are more likely to get higher returns. However, this is only looking at the PE ratio. We don't know about the future growth of the company, which is also important. And to find out the future growth, we're going to take a look at the next tool that I like to use, which is Yahoo Finance. And you've seen me using this website a lot. And this has a ton of information, not only charts, which you can use to chart your stocks, and you can also draw different indicators. So if I take a look at Meta stock, what I can do is go to the analysis and go down to next year, basically the growth estimate and the next 5 years. So this tells me what analysts are expecting the growth rate to be. So the next 5 years is probably a better number to look at because it's longer term than just the next year, but both are still important. Past 5 years, also important because that's an indicator of how fast the company has grown in the past. And if you see that the next 5 years is slowing down, then that kind of tells you maybe the business is slowing down. It's not projected to grow as fast as in the past, which for large companies like Meta and Google, it is expected. And over here on the right, they give you a good summary of recent analyst recommendations. So we have one downgrade there, which is not good. But let's take a look at Alphabet. I'll use GOOG here, and same thing, go to analysis, come down here to the growth estimates. Okay, so we have a 30 annualized growth over the last 5 years, coming down to 13%, not bad. But if we compare the two, so we have Meta on the left and we have Alphabet on the right, we can see that Alphabet is growing at almost twice as fast as Meta. So if we take that growth into consideration, then I would say Google is actually cheaper today than Meta, assuming those growth projections hold true over the next 5 years, which, is anybody's guess. But the more you understand these businesses, the more confident you'll be about their future growth projections and how that might change over time. And Yahoo also has a screener section, so you can screen for stocks similar to Finviz. And then you can build your own portfolio and have a watch list and all of that stuff. And finally, I'm just going to point out statistics here. This tab will give you an overview of the stock. Its 52-week highs and lows, also how many shares are outstanding, so you can calculate the market cap, institutional investors, the amount of short interest. So if a lot of people are shorting a stock, that could be interesting. You might find that stock trending on Wall Street Bets. And then some of the most important informations out of the financial statements, like the income statement, the balance sheet, and the cash flow. So very quickly, you can get like your free cash flow, for example. The next one I like to look at is CNN Business. I usually look at this in the afternoon or in the evening when I can take a look at what futures are doing, and that'll give me an idea of whether the next morning stock markets will go up or down. They also have information on world markets, so you can see what stock markets are doing around the world and also some currency movements, commodity price changes as well. And this kind of gives a good gauge of where inflation might go in the future. And finally, we have a quick look at what bonds are doing over here. And generally, if the yield is going up, then chances are the stock market will probably fall. And then finally, on the top here, they have a fear and greed index, which basically takes a bunch of different market indicators such as momentum and stock price breadth, and basically tells you in aggregate what the market is feeling. And this can be a good indicator of when there is peak fear in the market. Earlier this year, we got to below 20. Now we're at 41. So people are still pretty bearish, but they're not like super panicked. And then you can also see what the index was like a week ago, a month ago, a year ago. So the way I use this is if we're over here in the extreme greed, I would be like super careful and I would maybe do more covered calls and try to protect myself on the downside. And when it's in the extreme fear section over here, then that's when I would be looking at stocks that are on my watch list that are deeply discounted. And I would be considering adding those into my portfolio. And finally, we have Macrotrends, which is a really good site for comparing historical ratios. So for example, I'm looking at CrowdStrike right now as a potential buy for me. So I might sell a like out of the money put for this company. So if you just select on any of these metrics, it'll take you to like a CrowdStrike page, and it has some information here about the current like revenue and profit that I'm in. But I can also switch over to price ratios and look at, for example, the price to sales ratio, which is pretty important for a company like this. Now, because this stock hasn't been around for all that long, like only a couple of years, you can see that we only have this limited information for it, but it still kind of tells you price to sales ratio down here. So the higher this is, the more expensive it is. So looking at the historical chart, I can see that right now it's pretty much at one of the lowest points. So that tells me that there's potentially a buying opportunity here. But if we take a look at a company that's been around for longer, let's say Amazon, if I just leave the zoom to all here, we can see it goes all the way back to 2009. Okay, so Amazon's traded between somewhere like 1.5 to 4.5 times price to sales. And right now we're at sort of in the middle there, 2.69. So not super cheap, but also compared to just the last 5 years, this is actually a really good price to sales ratio right now. And if I didn't already have like 200 shares of Amazon, I would consider buying some right now because I can easily see this go up to above 3 over the next year. Plus you have the company itself growing. I'm pretty sure Amazon's going to grow double digits given its current trajectory. Let's see what the analysts say here. Yep, next 5 years, 33%. So that's pretty high. The other thing I just want to point out is on Yahoo Finance, for every stock, there is a recommendation rating. And if you know nothing about stocks, the lower this number, the more to the left, the better it is, generally speaking. So if you're comparing two stocks and you don't know which one is better, if one of them has a lower rating, then that's most likely the better one to buy. But as usual, extensive research is always needed, but that's like a good general rule of thumb to look at. So those are 4 tools that I regularly use to conduct my stock market research. And I've only shown the surface level of what these sites can do. And it's up to you to discover the rest of their functions if you're interested to look at them further. There are actually a lot more tools that I use, so let me know if you want to see more videos like this, and I'll be happy to share more websites such as these. Don't forget that trading platforms and whatever brokerage account you use often should have their own dedicated research section with reports and analyst ratings. For example, IB has the Fundamentals Explorer, which you can see a complete walkthrough of over here. Anyway, thanks always for watching. Hopefully these websites will help you on your investment journey, and until next time.